moment that Trump started talking about tariffs and this whole tariff diplomacy and resetting trade, I wrote a piece called Scapegoating, and the topic was this whole tariff trade war is going to steal attention from what is really the most important issue for the U.S. economy. And that, to be the broken record that I am, I think is the stubbornly high level of interest rates. I mean, the $37 trillion in debt that we have is not resolved by having this trade war resolved, even if it is. And we have $8 trillion in debt that has to roll between now and the end of the year. And we've got a 10-year yield that I just checked seconds ago before we jumped on here is now at 4.5. So despite a softer CPI and some, sort of softer comments from the Federal Reserve, we have this stubbornly high level of interest rates that will become a problem, as not only the U.S. government, but the private sector has to roll debt at rates that were substantially higher than they were paying prior. So, I'm happy to get into all the trade stuff, and I think it's important that we do, but I do want to emphasize that people shouldn't take their eye off the ball, because the interest rate picture is the most important issue for the U.S. economy. It's the biggest obstacle for the economy and the financial markets. And I think that will become clear once people settle down on the trade stuff and that steps to the sidelines and everyone has no choice but to focus on what's happening on the rate side. Well, I think clearly it's this issue of supply and demand. It would be my sense. If you're issuing $2 trillion in new paper, and in fact, because of the structure of our financing with a lot of T-bill issuance, we actually have to issue $8 trillion this year because we got $8 trillion maturing. You've got to come up with a lot of demand for that paper. And one thing the trade wars have done is to diminish any foreign appetite to buy our paper. And those used to be our reliable creditors. So we've taken them kind of off the table. And then you have the banks who are a little bit constrained so far, right, as of yet, as to how much more they can buy. And I know Scott Bessent, the Treasury Secretary, has talked about changing leverage ratios so as to free up more capacity for the domestic banks to purchase more Treasury paper. But, we could talk about that. I just think you don't really want to have our banking sector slavishly lending to the federal government rather than the private sector. Like, you really want them to be aggressively lending to new businesses, not to bloated government bureaucracy. So there's that source of buying. And then the other source of buying would be a sort of risk-off appetite by domestic institutions and individuals to buy Treasury paper in an environment that they perceive to be highly risky. But if you're taking the economic risks off the table with the tariff arrangements and all these deals that Trump has cobbled together, then the necessity of holding that kind of safe haven paper obviously goes away too. So you have this kind of perfect storm, let's say, of events where the reasons to buy are sort of diminishing at the same time our supply isn't diminishing at all. So that's the problem. I think the long-term issue for the Treasury market, day-to-day vagaries be what they are, is just this imbalance between the supply and the demand. And this is why you and I keep, going around and around on this, that ultimately I think the Federal Reserve ends up having to renew QE. So far, they've slowed QT and then slowed it again. They're tapering the taper and blah, 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 all on the way, I believe, ultimately to resuming their purchases of treasuries. But in terms of like a micro reason over the last couple of weeks, why rates have suddenly gone up, it's probably more technical. It's probably more related to the basis trade and players around that. Because again, like yesterday when the CPI printed light, you would have expected the 10-year yield to rally and rally hard, and it didn't, quite the contrary. So there's something different going on there, and it probably relates to some degree to this basis trade, but I don't have enough insight into, the players in that to be able to provide, some real powerful commentary on that. The problem with analyzing the Treasury market is that the issues could be triggered by something totally unrelated to the Treasury market, because the players that are positioning this basis trade are levered specs, hedge funds, who have positions in a variety of things, including private equity and private credit. And they have all these other positions that could be blowing up that's forcing them to liquidate treasuries to cover that, or is in some way causing a general deleveraging across the board. They want to bring down their exposures. And so the treasury basis trade is a part of that. So it's hard to look at what's happening with the treasury market in isolation and assume that you understand the dynamics, because the things that impinge on it may be totally unrelated to the actual treasury market just by virtue of the people who are positioning these trades right now. So it's complicated. The one thing I would say from a macro standpoint, though, is that when you try to parse out what's driving the backup in rates, is it real yields or is it inflation expectations? It hasn't really been inflation expectations. They, like the nominal bond yield, have been pretty steady state. You know, they never really came down as much as people would have liked them to have them come down, and they haven't really explained much of the increase either. So it's not that people are being jerked all over the place with their inflation expectations as much as it's that real yield, which does suggest it's more of a supply demand or a basis trade phenomenon than some kind of sentiment shift. Well, sadly, because of the nature of the financing, we have a huge amount of debt that rolls next year as well. The point is that the $2 trillion deficits don't really tell you the story about how much debt has to be refinanced. So yes, our deficit is only $2 trillion, but because we financed it all with T-bills and they're all coming due, those are rolling constantly. It ends up being an $8 trillion financing number this year. Next year, I think it's another $5 trillion. Basically, over this year and next, almost half of the total marketable debt, which is a little under 30 trillion, it comes due. So we're not out of the woods at the end of this year. But then the other question is, what's demand? So even if supply is going to go from 8 trillion this year to 4 trillion, let's say, what's demand going to do? Because if demand shrinks even more rapidly than it is now, you still got a problem. So you have to assume that the demand for treasuries is going to be solid, and the environment in which the demand for treasuries is going to be really substantial is one where the economic backdrop is pretty ugly. Either that, or it's an environment where the Federal Reserve is creating the demand by just printing the money and they are the sole buyer, which is a totally separate story with very different implications, but also not good. You and I have talked about this for a long time. I mean, like I said, I'm a broken record on the interest rate front, but because we're such a levered economy, both the government and the private sector, the interest rate picture is so paramount. And when the Fed first started raising rates, you know, I was warning, and you and I had conversations, and I'm sure people here who think I'm a negative Nelly are going to go back and say, oh, she said this, she was warning about this when the Fed was raising rates and everything turned out to be fine, except for SVB, let's say. But, you know, the problem is that we haven't had the relief for years. So even though, you know, the Fed tightening and then you had the SVB and then they immediately came in with the fire hoses like they normally do, and then rates kind of started to move back up again. And I'm sitting there tapping my fingers on the desk, waiting for all the bodies to start to float to the surface. What's happened is that every day that goes by that rates don't come down, more and more people start to fall by the wayside. So we've seen these corporate bankruptcies, et cetera. So the stress is there already. So I'm not sure that, I mean, we could talk about if it went to 5% or 5.5% or 6%. But as far as I'm concerned, if it just stays where it is, there are a whole bunch of people who have been counting on rates coming down, for whom the fact that they aren't coming down will be an existential problem. And there's, you know, the runway, I will admit, on that has been way longer than I ever imagined. I mean, the willingness of lenders to extend these loans, these distressed debt exchanges, et cetera, have been going on like crazy. And I would have figured that at some point they'd say, you know, we're going to stop throwing good money after bad here. And it just keeps going. But you're now starting to see some issues where, you know, I've seen interviews, because it's very hard to get data in private credit and what the value of, let's say, some of these private equity portfolio companies are really worth. You know, they're marked at 100%, but in reality, you know, they're probably worth nothing close to that. And when you listen to people who are in the space talking about what they're seeing, I mean, they're talking about haircuts on some of these, the few transactions that are being priced up to 50%. So, you know, the pain is there. Those companies can't survive. So again, every single day, more and more of those sort of bodies float to the surface. And I would point out that this was Janet Yellen's bet. she did the same thing. The reason she issued all treasuries was she was counting on Jay Powell to cut rates so that a year later she'd be a hero. She'd come in and say, look, rates are lower. We can refinance these bills that are maturing substantially lower. Well, it didn't work out that way. So I guess the long-winded answer to your question is rates don't necessarily have to go up from here. If they just don't come down, it's a problem. And I'll refresh the numbers. On the corporate side, there's $1 trillion in debt, corporate bonds that roll this year, and then 1.2 trillion right behind that next year. And again, heretofore, the appetite to continue to extend credit to these companies has been better than I thought it would be. But we're now getting to the point where a lot of these loans have already been, there's like that recidivism that you have with criminals, you have with the same companies. So these portfolio companies, is true. Yeah. I mean, where they come and they have their loans restructured, and then 6 months later, they need to do it again. And now you're seeing stories like the endowments are trying to get out of the private equity space because they've been expecting income to be thrown off of these portfolio companies as the firms were able to sell them. But you can't sell these companies. The lifespan of these companies, that how long they're sitting on the books, has gotten longer and longer. Right. So they're not generating the income. And first, you saw these stories where the endowments were actually going out and borrowing money to raise cash because they weren't getting the income from these PE investments. And now they're actually saying, no, we're going to get out of this space entirely. So that's probably the beginning of a turning point there. I think we're really pushing the limits on the patience of the creditors to continue to play this game. And again, if we don't get rate relief soon, I think that could be a major problem, which brings us to Jay Powell, I guess, and, kind of the box that Trump has now put him in, where almost Jay Powell has to not cut, because if he cuts, he appears to be caving into the administration.